the big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher.
A fresh economic report can send fortunes soaring or plummeting in the volatile world of precious metals trading. Here is a video of Andy Schectman that takes you to the heart of the action. Take a ride through the highs and lows of the market as we examine the sharp sell-offs in gold and silver following the latest government CPI report. From plunging prices to swift rebounds, all against a backdrop of global economic trends and monetary policy shifts, we'll uncover the intriguing twists and turns of the market. Let's hear him out again.
Yeah, I mean, I think 2000 is certainly a round number and appears to be support. It was resistance for a very, very long time. The fact that it came right back up is certainly bullish, and always coincides with some sort of numbers that are being released, whether it be the inflation or the unemployment numbers. And look, inflation is coming in much hotter than they anticipated, and well, that's not much of a surprise as far as I'm concerned. But the numbers that we keep being told, whether it be employment numbers and the price goes down, or the inflation numbers, they just seem to be less than accurate, I guess you could say. And the market reacts, or it is given a little bit of a push to react to those markets, certainly to make the system in an election year seem stronger than it is. Well, they bring out all these big employment numbers in January. They will be revised just like the entire 2023 numbers were revised downward by 40%. The revision in the unemployment numbers and the lack of clarity and transparency and the changing of the metrics used for gauging inflation in the CPI is justification when these numbers come out for short-term gyrations in the price of gold, and it's just more of the same. The noise, as far as I'm concerned, it's all noise, and the short-term movements, the short-term gyrations, the short-term technicals, to me, don't have much bearing whatsoever on the ultimate direction of the market moving forward. And again, look, I don't care what you see, gold dropping below 2000. You're seeing massive deliveries off of COMEX still over the last couple of weeks. Huge deliveries coming out of COMEX and huge deliveries coming off the LBMA, and gold being priced, almost $100 higher on Shanghai, and silver almost $3 higher on Shanghai. The big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher. One of these days, you will see a positioning like we see right now, where the commercial banks are in a very bullish position and the managed money in a very, very, in a short position and in a compromised position should the price start to go higher. And the question is, at what point will the commercial banks not sell into a rising market? That's really the question here. And Ted Butler talks about this all the time. Maybe we'll see that happen this time. Maybe this will be the move up. Maybe it won't be. But through all of this noise, we see the most well-funded and well-informed traders on the globe continue to drain the exchanges, continue to accumulate, using this price, this volatility in this tight trading range that people make a big deal of. But look at it from a step back. It's been in a trading range forever with great volatility. That's enabled the big money to pickpocket the exchanges. If it goes too low, it gets too much attention. If it goes too high, it gets too much attention. But keep it in a tight trading range with great counterintuitive and volatile price action, and you can systematically drain the exchanges. So I think the mistake a lot of people make is looking at the micro and looking at the short term and look at the big picture and see that the economic picture, see the big picture with the BRICS, see the big picture with the central banks accumulating it, see the big picture with the exchanges being bled dry, and then see the big picture growing of arbitrage rearing its head on the Shanghai Gold Exchange. The fact that silver is almost $2.80 or 90 cents an ounce higher in Shanghai than it is on the LBMA, and COMEX is a massive deal where you will see more and more metal arbitraged off for those big traders that have access to both. And I think this will come in a very abrupt fashion where one of these times the managed money gets caught with their pants down. They continue to think that everything is the same, and recency bias enables them to go naked short to very large positions. And as the price starts to rise, they'll have a very hard time finding anyone, i.e., the commercial banks, willing to sell metal to them at the prices that are being quoted on Western exchanges, which I think just about everyone watching this show would say are too cheap. Expiration of the bank term funding program and probably pretty dang close to the bleeding dry of the reverse repo market, meaning the liquidity in the system will be all but nil. And you know, I think that this is a very, very, very big deal. And if you look at it on a historical standard, look at the equity markets and the money supply moving in opposite directions, to see an all-time high basically in the equity markets while the money supply is dropping is a very ominous sign. And you know, last time that happened was, I think, if I'm not mistaken, right around the Great Depression, where it turns over and heads down. Look, this whole economy, Chris, is a byproduct of suppressed interest rates and easy money, a decade's worth, where, you know, you had money flowing all over the place and interest rates very cheap, and it enabled people to speculate. It created distortions in asset prices and in business conditions that, just as bullish as times were with easy money and low interest rates, I would argue will be exponentially more difficult and painful, the unwinding of all of these distortions, as we see the money supply falling off a cliff, the availability, if we take them at face value, of the Fed to come in and backstop these banks that otherwise, many of which probably would have failed. These banks had to post collateral at par, and you know, these loans need to be paid back, and that's what people aren't talking about. Is that, yeah, they got the money, but now these loans need to be paid back, and there's not going to be the help. And then all the money in the reverse repo market, which has been used to finance the Treasury's spending habits. Where does it come from? Where does the liquidity come from? Where does the money come from? It's not a good omen, if you will, for the future of the economy as we start to run into what I believe will be a recession. You got the head economist for Citibank saying by 2024 we will be by mid 24 a very deep recession. You're already seeing rumblings of it in Japan and in the UK and around the world, where you're seeing these countries that are starting to witness not only a slowdown in economic growth, but also a cascading global commercial real estate problem that is all kind of connected together. And I would suspect that 2024 will bring some very, certainly by March and April, some very eventful things. We talk about the banks in particular. Look, you got all of these loans and leases that need to be reset at much higher rates, that the regional banks hold the majority of all of those loans, 70%. So as we start to see the unwinding, as we start to see companies not be able to get liquidity that they need to run their businesses, creating big problems in the small businesses, the inability to reset your commercial real estate loan, where the Xerox building in Washington sells for about 10% of what it did 15 years ago. That's just one example. But as we start to see more problems in the commercial real estate problem, not just in the United States, but everywhere, the systemic nature of it will start to affect the economy as well. And then we get into the residential real estate. It all starts to snowball. But yeah, when you realize that much of the growth has been because of easy money and low interest rates, seeing the opposite and an acceleration in the money supply, making it that much harder to find credit, is only going to make things that much more difficult. At the same time, we see inflation very sticky and not going away. So we are on the cusp of, I don't know, stagflation, where you have little or no economic growth and contraction characterized by much higher prices and higher taxes. And I think we are heading into some tough times. And the banking issues, well, they're not behind us at all. Quite to the contrary, by March or April, we may actually see some rather interesting times in the banking sector.
From the dizzying highs to the gut-wrenching lows, We've traversed the ever-changing terrain of the market, guided by Andy's expertise. Now, as we bid adieu, we extend our gratitude for joining us on this exhilarating ride. If you found this exploration enriching, we kindly request your support. Subscribe, like, and share to spread the knowledge and keep the conversation alive. Until next time, may your investments be wise and your fortunes prosperous.